We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. Geopolitical panic replaced months of AI-fueled optimism as global markets snapped into full risk-off mode. Gold surged past $4,000 an ounce, an all-time high, while oil plunged below $58 a barrel in a stunning divergence that exposed deep macro tension. U.S. equities reversed sharply after Trump's new China tariff threats, and a prolonged government shutdown deepened investor anxiety. In Europe, France's political crisis and Germany's industrial collapse rattled confidence, while in Asia, Japan's bond yield spiked to 1.69%, the highest since 2008, and China's weak Golden Week data showed consumers still in retreat. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
Okay, if you track global markets, this week felt like a rubber band just snapped. Suddenly, for months, it was all about tech enthusiasm, AI, spirits were pretty high.
Right.
Then this week, total reversal. We went from, risk on forever to full-on geopolitical panic in, 48 hours, it felt like?
It really did. It was an immediate, almost visceral return to fear. Sentiment turned decisively risk-off globally, just driven by this perfect storm of political and policy shocks.
Yeah.
So our job today is really to cut through that noise for you.
Absolutely. Our mission here is to distill this week that was just dominated by politics, by panic, and frankly, some huge price shocks. We saw major moves across every big market.
Yeah.
So we'll break down what happened region by region and then crucially give you the 5 non-negotiable risks you really need to monitor next week.
And that snapshot of the risk-off mood is, well, it's staggering.
Right.
You had safe havens just screaming higher, gold surging past $4,000 an ounce. That's an all-time high.
Yeah.
Up 50% year to date.
Incredible.
Treasuries rallied hard. And on the flip side, global equity indices turned sharply negative. It was pretty clear-cut.
The overall theme seems crystal clear now. It's this mix of U.S. political dysfunction, the shutdown fears, renewed trade war talk, and some very real, tangible instability over in Europe.
Right.
These big macro-political forces, they just completely overshadowed any of that underlying strength we were still seeing in sectors like AI.
It just swamped it.
Okay, let's try and unpack this chaos. Starting where a lot of the shock came from. The United States. We saw this incredible contradiction this week, didn't we? Early on, U.S. equities were, still riding pretty high.
They were, benefiting from that big tech sector boost.
But that optimism, it was so short-lived. The reversal was profound. S&P 500 dropped 2.4%, NASDAQ down 2.5%, the Dow fell 2.7%.
Yeah, and the peak euphoria moment, though, that brief flash, was AMD shares surging 20% after announcing that partnership with OpenAI.
Which is amazing, right? But how quickly can one piece of really positive tech news bling? I mean, signaling massive AI uptake get completely wiped out. It felt like the market barely blinked at that 20% surge before the policy shock hit.
Well, it really speaks to the hierarchy of risk, doesn't it? Nothing seems to override a major policy threat. President Trump's surprise threat, this massive increase of tariffs on Chinese products,
right,
and then canceling that planned summit. It just instantly reignited those full-blown trade war fears. That's a systemic risk. It just dwarfs any single company's good news, even AMD's.
And when geopolitical risks spike that fast, you see that flight to safety. Treasuries rallied hard, reflecting both the trade jitters and, that deepening anxiety over the prolonged government shutdown.
Exactly.
But the commodity space, that gave us the most extreme moves, and maybe the most confusing signals.
This is where you see the real strategic tension playing out. Gold surges past $4,000 an ounce. That signals deep structural panic, right? Investors hedging against maybe long-term currency issues, fiscal instability. But conversely, oil plunged below $58 a barrel. That's a 5-month low.
Right. Help us wrestle with that signal because it feels contradictory. Are investors simultaneously betting on hyperinflation or currency failure and a global recession driven by slowing demand? How do you synthesize that?
It is the critical dynamic right now. The market is essentially hedging against two almost mutually exclusive outcomes. Gold anticipates a world where maybe central banks lose control, governments inflate away debt problems. Oil anticipates a world where global industrial activity, consumption, it just collapses under the weight of high rates and policy gridlock. That divergence, that's the single most important macro signal for you to watch right now.
We did get a little bit of background texture from the Fed's September meeting minutes. There were hints of potential further rate cuts later this year, citing labor market weakness specifically.
Yeah, but the caution is still really palpable there. The policymakers are deeply divided. Some are still arguing the current policy isn't even truly restrictive yet. And then you add the operational frustration of this ongoing government shutdown, which has delayed most major economic data releases. We're kind of flying blind on inflation and jobs right now.
Right.
All we really got was that Michigan consumer sentiment data, holding it as sort of mixed 55, this erosion of confidence in just basic fiscal governance. It's just another weight on the market.
Okay, moving across the Atlantic, Europe seemed to follow the U.S. lead, but with its own special flavor of political disaster this week.
Yeah, it did. The STOXX Europe 600 fell 1.1% from recent record highs. Started as profit-taking maybe, but quickly turned into panic buying of protection.
And the political fault lines there just seem to widen dramatically, particularly in France.
Oh, absolutely in France. Prime Minister Lecornu resigned. And critically, President Macron's proposed new cabinet was immediately rejected by the opposition. That political chaos just triggered immediate calls for early elections.
Now, political instability in France, it happens. It feels like it happens fairly often. Why is this specific government collapse raising, quote, serious sovereign stability concerns in the market now? Is the fear really systemic this time?
It feels like more than just localized anxiety. Look, France is one of the twin pillars of the Eurozone, right? Germany and France.
Right.
When one of those pillars faces serious political gridlock, it immediately raises questions about policy unity, about fiscal discipline, debt management across the entire currency bloc.
Okay.
And the market shows that fear by widening sovereign spreads, which basically means the perceived risk of default goes up, makes it much more expensive for the French government to borrow.
Yeah.
We saw the CAC 40 down over 2%, the FTSE in Italy down almost 3%. That's that immediate contagion fear playing out.
And while France was dealing with political implosion, Germany was dealing with, well, industrial implosion, a real hard economic reality check over there.
It was alarming data. German industrial output contracted a shocking 4.3% month over month in August. I mean, to put that in context, that's practically a collapse.
Wow.
And it was primarily driven by the auto production, just seizing up, the historical heart of German manufacturing strength.
And what was the clearest signal of that geopolitical risk feeding into the industrial pain? Was it in the details?
It was right there in the export data, a really severe disappointment. Specifically, a 20% year-over-year drop in exports to the U.S.
20%.
That's the clearest evidence yet that, yes, global demand is slowing, and yes, trade war fears are translating directly into lost revenue for major exporters. The German government did recognize the recessionary threat, though. They responded quickly with a targeted support package focused mainly on the auto sector.
That industrial pain in Germany, it contrasts a bit with the more localized weakness we saw in the UK, right? Where the Halifax house price index fell, 0.3% in September?
Yeah, it's a softer signal, but it definitely shows the housing sector there is still struggling.
Right.
Our ICS data also showed continued decline in buyer demand, transaction volumes still weak, different kind of pressure.
Okay, let's turn east, over to Asia, where Japan engaged in its typical high-speed political whiplash. Started the week hitting a record high.
Oh, yeah. Followed immediately by destabilizing news. It was a classic Japan wobble.
Okay.
The Nikkei 225 initially soared 5.1%. Huge move. Celebrating Sana Takaichi's LDP leadership win. But that optimism lasted, barely a day.
Right.
Before the reality check hit, the Komeito Party announced it was exiting the ruling coalition.
Which immediately throws everything up in the air, right? Raises the prospect of snap elections, destabilizes any new policy agenda before it can even get started. What was the technical market reaction?
Well, we saw a distinct weakening of the currency. The yen depreciated past 152.8 per dollar. But the really monumental technical event was in the bond market. The 10-year JGB yield climbed to 1.69%. That's its highest level since 2008.
Wait a second. Isn't the Bank of Japan supposed to be controlling that? Through yield curve control, how much political will or maybe market power is left to actually contain yields if the fiscal outlook looks this shaky?
That's exactly the question. This JGB spike signals that investors are basically betting on massive, loose fiscal spending from whoever forms the next government, regardless of what the central bank tries to do. It's a direct challenge to the BOJ's decades-long fight against deflation. It shows genuine, high-level fiscal stress building in Tokyo. That 1.69% yield, that's a crisis signal for them, seriously.
Okay, moving over to China. They had a relatively quiet resumption of trading after their Golden Week holiday. CSI 300 down about 0.5%, Hang Seng dropped more, 3.13%. But the real story wasn't the first day back trading, was it?
No, not at all. It was the data from the holiday itself. And that Golden Week data was, frankly, pretty disappointing. Retail and restaurant sales rose only 3.3%.
Only 3.3%. How does that compare?
Well, it's less than half the pace they saw during the May Labor Day holiday earlier this year.
Oof. Okay, so what's the implication there? For Beijing's long-term strategy and, more importantly, for our listeners' portfolios?
It signals pretty sustained consumer caution. It shows the ongoing core challenge Beijing faces in trying to rebalance growth away from infrastructure and investment towards domestic consumption.
Right.
And this matters globally because, look, if the Chinese consumer isn't spending, then everyone from global luxury goods companies to car exporters to commodity suppliers faces sustained pressure on their revenues. That 3.3% figure, it definitely rattles global growth forecasts.
So everyone's looking ahead now.
Exactly. Investors are now fixated on the upcoming fourth plenum. That's October 20th to 23rd. That's usually where Beijing unveils its blueprint for the next 5-year economic strategy, maybe signals potential stimulus, SOE reforms, that kind of thing. Big focus.
Okay, this is where it gets really interesting, right? We've recapped the bad news, the major cracks that opened up this week. Now, what should you be watching out for next week? October 13th through 17th, the calendar looks packed, especially with Q3 earnings season officially kicking off.
Yeah, the U.S. calendar is absolutely critical for setting the tone next week. Tuesday is huge. You've got Fed Chair Powell speaking, giving context on those minutes we talked about.
Right.
And then J.P. Morgan earnings kick off the entire Q3 season. How the banks frame the current economic outlook, their loan loss provisions, that'll be key.
And the economic data releases will be market moving, assuming, of course, the shutdown doesn't delay them further. We've got the crucial CPI inflation data on Wednesday. Everyone will be scrutinizing that, followed by retail sales and PPI on Thursday, and then industrial production on Friday.
A lot coming out. And globally, you'll want to keep an eye on China's trade balance and inflation data early in the week, plus the UK GDP month-over-month figures and Germany's ZEW survey for sentiment. These will give us context on whether that industrial and consumer pain we discussed is getting worse or maybe stabilizing a bit.
Okay, given the intense geopolitical flare-ups this week, let's nail down the top 5 risks. What are the 5 most immediate threats that could completely change the direction of global markets next week?
Okay, number 1, the escalating U.S.-China trade war. The market is really worried about the follow-through from Trump's tariff threats. If China retaliates, say, by restricting exports of critical stuff like rare earth minerals, it spirals very quickly into an immediate economic conflict. Big risk.
Got it. Number 2.
Number 2, the U.S. government shutdown prolonged. If this drags on, it's not just about delayed data anymore. It's a real erosion of investor confidence in basic fiscal governance. And that just compounds all the other global fears. Markets hate instability and unpredictability.
Makes sense. Number 3.
Number 3, European political instability. The fallout from France's government collapse affecting EU policy unity that really can't be underestimated. If snap elections are formally called in France, you'll see those sovereign spreads widen further, sending shockwaves through the continent's debt markets.
Okay. Risk 4.
Number 4, disappointing U.S. earnings season. Q3 expectations are actually pretty high, especially for those highly valued tech companies riding the AI wave. If they miss their numbers or if their margins start to decline because of rising costs, we could see a pretty vicious equity correction.
Yeah, the bar is high there. And finally, number 5.
Number 5, China's consumption weakness. After that tepid Golden Week data, if we get more definitive signs of faltering domestic demand in their upcoming macro releases, it will force analysts globally to revise growth forecasts down again. That creates this persistent pressure.
Okay. So what does this all mean for you listening right now? This past week was, I think, a stark and probably necessary reminder that political and geopolitical risks, they carry more weight sometimes than even the strongest sector performance. Geopolitics can really set the ceiling, maybe more than fundamentals right now.
Absolutely. Yeah. And the overriding signal we have to end on is that profound divergence we talked about between asset classes. When a traditional safe haven like gold is hitting record highs above $4,000 an ounce, I mean, that's a true inflation or systemic crisis hedge.
Right.
While at the same time, oil is collapsing because of recessionary demand fears. What does that fundamentally tell us about the perceived long-term safety of the underlying equity market growth story? That divergence, basically betting on total collapse and total boom simultaneously, that's the critical strategic puzzle you should really be wrestling with heading into next week.
Stay informed, stay vigilant out there, and we'll see you on the next deep dive. Okay.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.